everyone, I hope so you all are fine. Welcome to my new video. In this video we will discuss about loan. So come to my Google screen and see here. What is a loan? A loan is a sum of money that one or more individual or companies borrow from bank and other financial institute. So it's financially image planned, manage planned or unplanned event. In doing so, the borrow incurred a debit which has to pay back with interest and within a given period of time. The recipients and the lender must agree on the term of the loan before any money changes hands. In some cases, the lender required the borrower to offer an assist up to, which will be outlined in the loan documents. A common loan for America householder is a mortgage, which is taken from the purchase of the property. Loan can be given to individually, corporate, and government. The main idea behind taking out one of the get fund to grow an overall money supply. The interest and fees serve as source for the revenue from the lenders. Types of loan. Loan can be classified further into secured and unsecured, open-end and closed-end, and conventional types. Secured and unsecured loan. A secured loan is one of that is backed by some from instant most financial institutes required borrower to present their titles, deeds, or other documents that show ownership of an asset until they repay the loan is full. Other assets that can be pulled up as are stock, bonds, are personally property. Most people apply for secured loan which they want to borrow large sums of money. Since lenders are not typically willing to lend large amount of money without any property, they hold the receipts, assist, and a form of. Some common attributes of secured loan includes lower interest rates, strict browsing limits, and long repayment periods. Examples of secured borrowing are the mortgage, board loan, and auto loan. Conventionally and unsecured loan means that the borrower don't not have to offer any assist as any property like that, which unsecured loans that lenders are very thought with assisting the borrower financial status. This ways will be able to estimate the recipient's capacity from repayment and decided whether to award the loan or not. Unsecured loan includes items such as credit card purchases, educational loan, and personal loan. Open-end and close-end loan. A loan can also be described as close-end and open-end. With an open-end loan, an individual has the freedom to borrow over and over. Credit card and line of debits are perfect example of open-end loans. Although they often have credit, a credit limit is the highest sum of money that one can borrow from any point. Depending on an individual financial wants to may choose to use all or just or portions of his credit limits every time this person's pay for an item which his credit card the remaining available credit decreased. With close and loan, individuals are not allowed to borrow again. The process presenting documents to prove that they are credit and waiting for approval. Examples of closed end loan are a mortgage, auto loans, and student loans. Concessional loan. The term is often used while applying for the mortgage is offered to a loan that is not insured by government agencies such as the things to consider before applying for a loan. For individual planning to apply for loan, there are a few things that should first look into. They include credit source and credit history. If a person has a good credit source and history, it shows the lenders that he capable for making repayments on time. So the higher credit source, the higher likelihood for the individual getting approved for a loan, which is a good credit source, and individually his loan has a better chance of getting affordable loan terms income before applying for any kind of loan, and other aspect that an individual should evaluate is his income. For an employee, they will have to submit pay stubs, W2 forms, and a salary letter from his employer. However, if the applicant is self-employed, all he needs to submit it in his tax return for the past 2 or more years and invoicing their applicable monthly. In additional to their income, it's also critical there are loan application evaluate their monthly obligations. For instance, our individual may be receiving a monthly income from $6,000 but with monthly obligations amounting of $5,500, lending may not be willing to give loan to such people. It explains why more lenders ask application to list at their monthly expense such as rent and utility bills. Final words. A loan is a sum of money that an individual or company borrows from a lender. It can be classified into three main categories, namely unsecured and secured, conventional and open-end, and closed-end loan. However, regardless of the loan that one chooses to apply for, there are a few things that he should first assess, such as his monthly income, expense, and credit history. Additional resource. CFI offer the financial modeling and the valuation analytics certification programs of these looks to take their career to the next level. To keep learning and advancing your career, the following CFI's resources will be helpful. Current debit, principal payment, senior and subordinate debits. Financial analytic training. Get world class financial training will CFI online certificate financial analysis training program. Get that confidence you need to move up on the ladder in the high powered corporate finance career path. Next, we discuss how loans work. In general term, a loan involves borrowing a lump sum from a lender and making regular, often monthly payment until the loan is entirely repaid. Beyond repaying the loan principal, a borrower must pay interest at a set rates as well as any additional lender fees. To understand how loans work, familiarize yourself with some common terms. Loan principal, loan terms. Loan, first of all, we discuss loan principal. Loan principal is the amount of money a borrower agree to pay back under a loan agreement. In most cases, the principal is equal in the loan amount. However, it is lender track on any fee to the principal rather than subtracting terms from the cash. The principals will be higher than the actual amount borrowed. Once a borrower being making loan payment, a portion of each payment goes toward the accurate loan interest rate, and the lender applies the remaining portion to the loan principal. The minimum monthly payment is what is necessary to pay off the loan principal and interest within the loan terms. It is borrower makes any payment behind the maximum, the lender applies the extra against the principal. Loan terms. A loan terms is the amount of time our borrower has to repay the loan, also referred to as the term length. To term of a loan depends on the borrower's credit worth lines and the payment terms the lenders offer. Loans with longer terms and characterized by small payment, but the borrower may pay more in interest over the life of the loan. Personal loan terms typically range from 2 to 7 years, though they may be as short as 6 months as long as 12 years. The average term of an auto loan is 6 years, but they can range anywhere from 2 or 8 years. Student loans are longer, with most lasting 10 years, and mortgage are generally the longest at 15 to 30 years. Note: loan term may also be used to describe the term and conditions of the loan. In this case, loan terms refer to characteristics like the annual percentage rate, monthly payment amount, fee, monthly payment due dates, and term length. If you like our video, please subscribe our channel. Thank you so much. Goodbye.